Okay, some of you, right? Yeah. Okay, so the first one. So if you haven't participated yet, please raise your hand. This is not a challenging question, right? Oh, okay, I already answered the first one. So when the full costs of production are included, this is called absorption costing. But it's sometimes more appropriate to use either variable costing or to include only direct materials called or what? Roger?
Super variable costing.
Yeah, thank you. The two types of demand capacity that can be used in the denominator to calculate utilize the fixed cost rate are long-term demand or short-term demand called. What is the long-term demand called? We are talking about demand capacity. There are only two, right, for demand. And the long-term one is called, let's see. Oh, you guys all answered the questions. Come on, those ones who haven't never answered the questions. Oh, channel, sorry, channel? Oh, channel.
Is it normal capacity?
Normal capacity? Okay, very good. Thank you. How do I pronounce your name?
Shinoa.
Shino. Okay, thank you.
Yeah.
That's correct. And what's the other one? 13245. I don't know who you are, but 130245.
Yeah, that's me. It's Jeremy. Yeah, sorry about that.
Yeah, okay.
I think I already sent you a lot, but if you want that one,
the master.
Yeah, so this is the master budget capacity. Okay. And then the third one, the only acceptable measure for CRA is, and what is the ASB and EFRS requirement? So all the ones with hands up, those are the person have already participated. So it's almost like I'm begging you to give you a mark. Please, I want to give you a mark. Okay, that's fine. Roger, nobody. Yeah, I can't be too aggressive. Roger?
I think the first one is master budget capacity.
Yeah. Okay. And the first one is the master, right? Okay, good. So that's done. We only have one more question left. Okay. So that's the question E9-18. E9-18. If you have done this question, please raise your hand. I want to see how many of you have done this before the class. Oh, 3 of you. That's not bad. So, okay, so how do you guys find it? It's pretty challenging or it's okay?
I feel like they're hard to do at first, and then it kind of like clicks. So you just have to keep going through it, and then you read, like I've been reading sections of the textbook that relate to it, and they often have examples that kind of add what you're missing, so you can get it eventually. And if you power through it, once you've done it, you have it. Okay, good. Yeah, but it's the same for always, right? For when you learn anything, right? You just have to read more, right? And try to see the gap in your understanding, right? Yeah, okay, that's good to know. So for this question, you definitely want to know this, to do a question like this, okay? So this is a question for the two costings. You want to explain the operating income difference, okay? So this 4K Play Incorporation manufactures and sells 50-inch television sets and uses standard costing. Budgeted level production is 1,000 units per month. Actual data relating to January, February, and March are. So you can see these columns are by the months, January, February, March.
And these rows are giving some information, unit data, beginning inventory. So starting in January, 0, and 300, 300. Production is varies, 1,000, 800, 1250. And sales does not necessarily equal to production, right? So 700, 800, 1500. So it's interesting, right? When you are just comparing these two sets of numbers, you should know something about it, right? For example, for February, if I compare production and sales numbers, what do you know? For February, if you compare production and sales numbers, what did you learn? Mikako?
Yeah, so it's plus minus 0. So that means both the absorption costing and variable costing operational income should be same.
Should be the same, right? Because the production is equals to the sales, right? Good, very good. We just talked about it, right? And for January, production is more than sales. Which one is higher? Is that absorption is higher or the variable is higher for January? You check who?
Absorption will be higher.
Yeah, absorption will be higher. And for March, production is less than sales. So the variable will be higher, right? So even before you do the calculation, right? Even before you try any numbers, just by reading these questions, informations, you should have a prediction already, right? So if your result is not consistent with your prediction, you must done something wrong, okay? You must done something wrong, okay? So I remember when I was in the final exams, I finished earlier, right? I will use different ways to redo my question, okay? If I still get the same result, okay, then I know for sure, you know, my answer is correct. So sometimes you don't have to be happy with only knowing how to do it. You can think about alternative to do it, maybe a better way to do it, right? So those are the things, you know, you should consider, yeah. And then the variable costs, manufacturing cost per unit produced. So that's 900. Operating marketing cost per unit sold. Okay, so if this is related to the sales, right? So, but for the marketing people, if they sell each unit, that variable cost is $600. Okay, so those are the variable cost. Oops. And then what's are the fixed cost? Manufacturing cost, 400,000, right? It's fixed. That's why it's the same number. I don't know why this computer, this slides is always doing things like this. Okay, if it's a fixed cost, that means it's the fixed across the months, right? So 4,000 for manufacturing, 140 for the marketing, right? And the selling price per unit is 3,000. So that's the information we got, okay? The first question is the present statements of the comprehensive income for January, February, and March, okay, the 3 months, under a variable costing, A, and B, and absorption costing, okay? So we are going to do the first question. So this is our first question. So with all these informations, I want first to deal with the inventory, right? Why do I work on the inventory first? So I want to know what's the beginning inventory, what's the ending inventory. Can anyone tell me why should I care, pay attention to inventory? Reen?
Is it because that's like the whole purpose of this chapter? We're tracing the inventory, either fixed or variable.
Mm-hmm. Yep, definitely.
So if
Definitely
you
there is.
didn't pay attention to it, you wouldn't be able to attribute it.
Yeah, yeah, very good. Okay, so let's take a look at the inventory, right? For January, the beginning inventory is 0. Are you following me? I'm moving my cursor. Can you see? Are you able to see my cursor?
Yes.
Yes.
Okay, so see, I didn't do anything. I don't know why. This really bothers me. So beginning inventory for January is 0, okay? And the production is 1,000 and sales is 700. So you overproduced 300. That will be sitting at your ending inventory, right? So this red color is numbers all for January. So your ending inventory for January is 300, right? Because you produced 1,000, which is 300 more than the sales, 700. So the unsold 300 will be sitting at your ending inventory. So this becomes your beginning inventory for February. So if you take a look at the blue color for February, opening with which is the ending of January, 300, and the sales here is the 800. So total goods available is 1,100, and they sell 800. So the ending inventory is also 300, and which become the beginning of March. Okay, that's the March 300, and the production is 1,250. So together you have 1,550. That's the total goods available for sale, and the sales is 1,500. Right, units sold is 1,500. So the ending inventory for at the end of March is 50. Are we clear with this? 1, 2, 3. In terms of the inventory, beginning, ending, and how did I calculate it? Oh, wow. Lots of accidents, right? Lots of accidents. Are we okay with this? Okay, so now let's take a look at the format, the presentation format for the income statement under variable costing, okay? So under variable costing, you have revenue, you start with revenue, and then one thing I learned, to be a professor, you have to be really patient. You know, you just can't show your frustration, right? Even when you are very frustrated, you have to keep smiling, okay? So the variable costs, okay, that's under revenue. So what's for the variable cost? You have a beginning inventory and the total variable manufacturing cost, okay? And then you add them together. That's the cost of goods available for sale. And then you minus the ending inventory, okay? So that's the variable cost of goods sold. And then you also have variable operating cost. Together, you have total variable cost, okay? The difference between revenue and the total variable cost, that will be your contribution margin, right? And then you minus your fixed cost, that's gonna be your operating income. And there are two components of fixed cost. One is manufacturing cost, one is operating cost. So are we clear in terms of the format? For variable costing format, are we clear with this? 1, 2, 3, sum up. So that's the format for the income statement format for variable costing, okay? If you don't know it, just to read some of the examples and try to be familiar with this, okay? So you have a revenue, okay? And then you have a variable section for the variable cost of goods sold. And you have variable operating cost. And the difference between revenue and the variable cost, that's called the contribution margin. And then you have fixed cost, two components, manufacturing and the operating. And the difference between contribution and the fixed cost, that's your operating income, okay? So let's do the first one, January. January, what's my revenue? So revenue equals sales volume times selling price per unit. What's my sales volume for January? Just shout it out. What's the sales volume for January?
700.
700. And what's the selling price per unit?
3,000.
Okay, 3,000. So 3,000 times 700. So that's 2.1 million. That's my revenue. Okay. So now let's move on to the variable cost. What is my beginning inventory? What's the cost of beginning inventory?
0.
0. Good. What is the variable manufacturing cost? Variable manufacturing cost. How many? So we want to know the production, right? What's the production level? How many units produced in January?
1,000.
1,000. And for unit production, manufacturing cost is how? What's the unit cost? Variable
900.
900. So 900 times 1,000, 900,000. Okay. So when I add these two together, that's the cost goods available for sale, right? 0 plus 900. That's my 900. It ruins my animation. So 900,000. Okay. What about the ending inventory? So for ending inventory, how many units in the ending inventory?
300.
300. And what's the cost per unit, manufacturing cost per unit?
900.
900. So 300 units, and each unit, the variable manufacturing cost is 900. So 300 times 900, so that's 270,000 ending. So 900 is total available. What's left unsold is 270. The difference is the variable cost of goods sold, which is 630,000. Okay. What about my variable operating cost? How do I calculate this? Variable operating cost, this is about unit sold. How many units sold in January?
700.
700. So be careful, there are two units numbers. One is production units, the other one is sales units, right? So this variable operating cost is related to the units sold. So they sold 700 units. What's the selling cost? What's the variable operating cost per unit sold?
600.
600. Yeah, here 600. So 700 times 600. The number is 420,000. Okay. So when I add my variable cost of goods sold and the variable operating cost together, that's my total variable cost. So these two numbers add up to be 1,050,000. Okay. So what's my contribution margin? What's my contribution margin?
1.05 million.
Okay. Yeah, very good. What's my fixed manufacturing cost? What's my fixed operating cost?
400,000.
Yeah, 400,000 and 140, right? So this adds up. Total fixed cost is 540,000 and 1,050,000 minus 540,000. That's 510,000. That's my operating income. Is this good? Okay. So now to February, you are doing exactly the same thing. For February, when you talk about revenues, use sales units. So you are selling 800 units. Each unit is 3,000. So 800 times 3,000, 2.4 million. Beginning inventory. What's the beginning inventory?
300.
300. Yeah, the beginning inventory in units. In units, it's 300. What about here is our cost, right? In the income statement. What's
Just
the
the
begin-
line.
Hmm?
It's the deduct ending inventory line from the previous.
What is the number?
It's 270,000.
Yeah, very good. 270 is from here, right? From the ending of January, 270,000. Variable manufacturing cost. So variable manufacturing cost, that's the production, right? Make sure you use the production units. So the production for February is also 800, and the cost per unit is 900. So 800 times 900, 72,000, okay? So total goods available, these two numbers together, 990,000. What's in the ending inventory? 300 units in the ending inventory. And what's the cost in the ending inventory?
270 again.
Yeah, very good. And so then the difference, that would be the variable cost of goods sold. So this difference is 72,000. Okay, variable operating cost, I'm using the sales, right? So sales is 800 and per unit is 600. So 800 times 600, that's 48. Oops, yeah, that's 48,000, right? So my total variable cost will be these two together. That is 1.2 million. And the 2.4 minus 1.2, so my contribution margin is 1.2. What is the fixed cost? It's exactly the same because they are the fixed cost. So 1.2 million minus 540,000, that's the 660,000. Okay, 660,000. Are they okay with my February? Okay, so let's see. Okay, 1, 2, 3. Are we okay with January and February? Okay, good. Yeah, awesome. Now let's do March. Okay, exactly the same. Revenue, you are using sales numbers. So 1,500, for sales, 1,500, right? Times 3,000. So that's gonna be 4.5 million, right? And what's the opening of March? What's the opening of March?
270,000.
Opening balance? Opening balance for the inventory for March.
Also,
270,000.
Yeah. So that will be the ending of February, right? So that's this direction. Okay, and then variable manufacturing cost. Can anyone tell me how do you calculate the variable manufacturing cost for March? So you use 900, that's unit cost, times units production, 1250. 1250 times 900. So 1.125, okay, 1.125. And then your total goods available, just add them together, okay? And then what's your ending inventory? In the ending, there are 50 units left, and each unit manufacturing cost is 900. So 50 times 900, that is 45,000. So the variable cost of goods sold will be this difference, so 1.35 million. And the variable operating cost will be sales, right? So 1,500, they sell 1,500, each $600 per unit. So that will be 1,500 times 600, that will be 900,000. So total variable cost is the sum of these two numbers, 2.25 million. Contribution margin, 4.5 million minus 2.25 million, that will be 2.25 million. And the fixed cost is still the same. For 50,000, And the difference, net operating income is $1.71 million. See, this is how we do this under the variable costing. Do we have any questions on this? No question, Lily, good. Okay, so I will move on to the absorption costing. So first, let's take a look at the format for absorption costing, okay? So again, you start with revenue, okay? And then you have cost of goods sold, right? Cost of goods sold. And the difference is gross margin. And then you have operating cost. And then you have operating income, okay? So how to calculate the cost of goods sold? You have a beginning inventory balance, and then you just add manufacturing cost. Could be variable or fixed, right? So you just add manufacturing cost, could be variable or fixed. And this all together, that's your goods available. And then you minus your ending inventory. That's your, that is the cost goods sold. But don't forget, you have to make adjustment for the production volume variance. Okay, I'm going to explain this later. And then you figured out what's your cost goods sold, and then revenue minus cost goods sold, you get gross margin, okay? So here, revenue numbers will be the same, 2.1, 2.4, 4.5. This is calculated exactly the same number as the under the variable costing, right? Variable manufacturing cost, this is exactly the same as the variable cost, right? These numbers are exactly the same. 900, 720, 1.125, right? This part is new. Allocated fixed manufacturing cost. So we are saying how much fixed manufacturing cost allocated here. The difference between absorption and the variable is under the absorption, the fixed manufacturing cost is included, right, in the inventory. So here we want to know, what is the allocation of the fixed manufacturing overhead. So first tell me what is the amount of the fixed manufacturing cost?
400,000.
400,000, right? This is the 400,000. Okay. Now we have to think about the capacity, right? We need to think about the capacity. We need to figure out the rate, right? We need to figure out the fixed overhead rate. Right now we only know the budgeted fixed manufacturing cost, 400,000, right? In order to get a rate, we need to know the denominators. What do you think that denominators will be for this question?
Manufacturing cost divided by production.
Yeah. So which production? There are different levels, right? Which number?
January production.
Pardon me?
January production.
Divided by the production. Yes, production level, right? What is that number?
The 1,000.
1,000. Very good. Did you see here? Just at the end of the question, it said the budgeted production level is 1,000 units per month, right? Okay, so this is kind of my normal capacity, right? This is kind of my normal capacity. They expect the budgeted level of production is this. So my rate would be 400,000 divided by 1,000. So that's 400 per unit, right? 400 per unit. Okay, does that make sense?
Yes.
Okay, so remember that 400 per units. How many productions we have for January? 1,000 units, right? And each unit is $400, right? So my allocation is 400 per unit times 1,000, so 400,000. Okay, that's how I got this number. So when you add all this together, so your manufacturing cost would be 1.3, opening balance is 0, opening the inventory. So your cost of goods available for sale is 1.3 million. Now, deduct ending inventory. Okay, what is the ending inventory? So that's a very good question. So what is the cost in the ending inventory? So the production cost, right? It has two components: variable manufacturing versus fixed manufacturing, right? What is the variable manufacturing per unit? What is the variable manufacturing cost per unit?
900.
900. And what is the fixed manufacturing overhead per unit?
400.
Together?
1,300.
Yeah, 1,300, right? So the manufacturing cost per unit is $1,300 per unit. How many units in the ending inventory?
300.
300. So 300 times 1,300. That is the ending inventory cost, which is 390,000. Okay, 390,000. How about the production volume variance? So your budget is 1,000 units. What's the actual production for January?
1,000.
1,000. So it's exactly the budget, right? So there is no production volume variance because the normal capacity is 1,000. That's the number you use for the denominator. And the actual production is also 1,000, right? So there is no production volume variance, okay? So now you figure this out. So 1.3 minus 390, so that's the 910,000 cost of goods sold. And then 2.1 million minus 910,000, you get 1.19 million gross margin. Okay, gross margin. Now you want to calculate what's my operating cost. It has two components, variable and fixed. The variable part we have already calculated, right? 420, 480, 900. Remember this number? We calculated already from here. Variable operating. See, 420 and 480 and 900, right? This variable operating cost we already calculated. 420, 480, 900. So that's this part, 420, 480, 900. Fixed operating cost, it's 140, right? It's 140 everywhere. Okay. So now adding these two gives me the total operating cost, and the difference is my operating income. So for January, my operating income is 630,000. For February is 660,000, and for March is 1.61 thousand. Okay. So for February and March, all the calculations are similar, except here adjustment for production volume. So for February, the production volume is 800 and the budget is 1,000. So the budget is 1,000, you only produce 800. So that's not a good variance, right? So there are $200 difference, right? So $200 difference times $400 per unit, right? Remember, the 1,000 is the normal capacity minus 800. That's the actual capacity, right? So the difference is 200 times the fixed manufacturing overhead rate, which is 400. So that's how I get this unfavorable 80,000. Okay. And in March, so my production is 1250, is more than 1,000. So this I have a favorable, I produce more than I budget. I have a favorable variance. So how do I calculate it? So I use 1,000 minus 1250 and times the 400, right? So that will be 250 times 400. So that will be 100,000 favorable here, right? Okay, so are we okay with the absorption costing?
Can you explain one more time about the ending inventory? I kind of got lost.
With the ending inventory?
Yes, please.
Yeah, no problem. Okay. For the ending inventory, it's the manufacturing cost, right? The manufacturing cost. You want to know what's the manufacturing cost per unit, right? So it has two components, variable and the fixed. The variable is given. You can see that the variable manufacturing cost per unit is 900. And the fixed is 400. So 900 plus 400, that's a 1,300. So my manufacturing cost per unit is 1,300. And in January, the ending inventory is 300 units. Each unit costs 1,300. So 300 times 1,300. So that's the 390,000. That is this number, 390,000. Does that make sense?
Yeah, it does. Thank you.
Okay, good. So just give me 1 second. Okay, so
Hi, Professor.
yeah.
Why we are at the unfavorable variance and deducting the favorable variance when we're making an adjustment for PVV?
So sorry, what you are saying this adjustment for the production volume variance?
Yes.
What is your question?
Why we are adding the unfavorable variance, but in March we are making
okay, yeah, because it's a cost, right? If it's unfavorable, that means it costs you more, right? If it costs you less, you should be happy, right? Does that make sense?
Yes.
Yeah. So you if it's unfavorable, that means you don't like it, right? So that means it costs you more, right? If it's favorable, that means it costs you less. So therefore you reduce it, you minus it. Okay. Okay, if you understand this, please sum up. 1, 2, 3, go. Okay, yeah, I think it's half of the class. The other half, make sure you practice on some questions. Sometimes you just have to take the time and do it very slowly, right? And and try to understand where this number comes from, right? You have to be able to draw the connection, okay? At least that's how I get good at this. I did a lot of practice questions. Yeah. Okay, so now I just use another 5 minutes, then we are done, okay? Sorry for taking this long. So let's compare the number, okay? Let's compare the number. So again, if you use the operating income, the absorption minus variable, that should be the fixed manufacturing cost in ending inventory minus fixed cost in the beginning inventory. So for January, these two numbers we already calculated, right? And we know the difference is 120,000. And for the inventory side, the opening inventory is 0, ending inventory is 400 times 300 units. So you can see both sides is 120,000. And as predicted, February, the difference is 0 because production equals sales, okay? So basically, you know that the ending inventory and the beginning inventory is always 120,000. Okay, and for March, as predicted, we have less operating income under absorption costing, so we get the negative numbers on the equation. So 1.61 million minus 1.71 million, that's a negative 100,000. And on the other side, the opening is still 120,000. The ending is only 50, right? At the end of March, there's only 50 units left. So this is 20,000. 20,000 minus 120,000. So you have negative 100,000. So you can see when we tested, this equation, it works very well, right? So sometimes you don't have to calculate. So if you know the variable costing operating income, if you know the ending inventory balance, beginning balance, you don't have to calculate absorption costing the way I do it. You can just use this equation, right? You can just use this equation. Okay, so that's it. Boy, it's 8:20, 8:30. Okay, sorry for taking so long, and it's a lot of calculations, and I hope it makes sense. If it doesn't make sense, you have to rewatch my video and try to do it slowly. Okay, slow motion, slow down my pace. I can go slower. You can see I'm almost running out of time. Okay, so does anyone have any question? If there's no question, it's 8:30, and it's class is dismissed, and I will start the chapter 9 quiz and assignment tomorrow. Okay, so yeah, let me know if you have any questions. Other than that, have a good rest and have a good weekend. Okay, yeah, I will see you next Friday then.
Thank you, Professor. Good night.
Yeah, take care. Bye bye.
Professor, I just had one question about the last test we did, the quiz.
Yeah.
I sent you an email with the screenshot, but 3 of my questions didn't have a question. It just had the answers.
That's true. It talked about a clay pot and there was no question on a clay pot, but I think it was 17, 18, and 19. Yeah.
Yeah, so it's 18, 19, and 20.
Okay, 3 questions.
Yeah, they're back to back. Like
I don't know if you
guess
can
on them.
see, but I also flagged the questions. They're the same questions.
Okay, that's weird. So how many marks for each question?
I think it was
1 mark
one
each.
per. I just guessed. I got 2 of them wrong still, but
Okay.
I guessed as well,
there's
so I need to check my mark.
Yeah, I will. Yeah, I will probably just give you guys all the mark.
Yeah, we couldn't get any answer, any options
Yeah.
from the answer.
So
I was trying
just,
to like retrofit
yeah.
the previous question, but it wasn't working in any way. I was like, this doesn't apply to this question.
Okay.
I did it for
Yeah,
like 30 minutes.
the question
I
was
noticed.
about.
I noticed.
The
that Pearson-
questions were about bottles, plastic bottles, and then the options were about clay pots.
Yeah, I noticed the Pearson this question bank has issues, right? This is not the first time.
That was the Moodle one, just to
Yeah.
clarify.
So I think I will report this to Pearson because this is all the questions downloaded from the Pearson's question banks, right?
Professor, I had a question. When are you going to post this video so we can watch it again?
This video?
Yeah, can you do it tonight or like maybe tomorrow?
I'm a little bit tired tonight, so
Okay.
I will do it tomorrow. Okay? Yeah.
Thank you.
And what about the slides? They're not posted yet.
Just give me 1 second. Let me stop recording.